Hi everyone, I'm Mubina Kapasi and I'm joined by Deepak Agrawal, the Chief Investment Officer for Debt with Kotak Mutual Fund. Deepak, thanks so much for joining us. We're here to discuss the outlook for the fixed income market in November. So let's talk first about the month gone by. What transpired in the global fixed income market in the last 1 month?
See, over the course of last 45 days, we have seen significant rise in global bond yields. It all started from the Fed policy in mid-September. So let's say earlier in June, Fed had given a guidance or Fed dot plot suggested that Fed will cut rates by 100 basis point in calendar year 2024. But they were scaled lower to 50 basis point in the September policy. So basically Fed is giving a message that Fed is willing to stay higher for longer because the economy is doing well and they want to bring down inflation to 2%. This factor, along with let's say higher supply of long-term bonds in US, as well as Fed conducting the quantitative tightening, actually led to the increase in term premium. And we saw the decent spike in US long-term yields. But all this while, the 2-year bond in US has been steady at 5%. That means market is saying that falling inflation will keep Fed on hold for a longer period of time. But at the same time, Fed is going to remain at these levels for a longer period of time. Now, along with US, we have also seen spike in Australian bond yields, which have risen by close to 70 basis points over the last 45 days.
Of course, our focus is on the United States, right? And what the Fed is going to do. What's your outlook on how US rates could shape up in the coming months?
See, markets, long-term yields in US have been very, very volatile. Last 15 days also, if you see, US 10-year has been gyrating between 460 to 5%. And we believe Fed is more or less done with hikes. Yes, the data continues to remain strong. Retail sales growth is strong. The third quarter GDP also came at 4.9%. There are fewer jobless claims. So the economy on a whole is doing good, but the good part is that inflation is also trending lower. But then it's about cuts. Though we believe that Fed, when it starts cutting in the second half next year, it will cut rates by 150 basis point. But for now, market is pricing in close to 75 basis cut next. Therefore, in the near term, given that there is higher supply of bonds and Fed still continues with quantitative tightening, we believe that the 10-year bond in US may continue to trade in the band of 460 to 5.
So this was, of course, about the month gone by. Let's talk about what we're expecting from here on, especially from the US. Do you think yields will, go back to that 5% mark, the 10-year one?
You would have seen over the course of last 45 days, in fact, the inversion in US yield curve has actually reduced. From 65 basis point negative spread between a 2-year 10-year bond, that is down to 15 basis point. Now, if Fed is not hiking further and the next action from Fed is likely to be a cut, we believe that the yield curve, which is currently inverted, might steepen over the course of next 3 to 4 months.
Now let's shift the focus to closer back home. How have you seen the Indian debt market move in the last 1 month?
See, let's say in US, so from mid-September, where in US the yields have gone up from 435 to 5%, the rise in India has been relatively muted. Our 10-year bond from mid-September till date has been trading in the band of 710 to 740. So what factors led to the rise in our bond yields to be muted? One, our bonds, there were expectations of our bonds to be included in JP Morgan bond index, and the inclusion finally happened. That's going to bring in $25 billion of inflows next year. So that's a substantial flow, which is going to, and if you look at in terms of the net borrowing of Government of India next year, that's close to 15% of the total supply will be absorbed by these flows. So that factors led to relatively less rise in our bond yields compared to US bond yields. At the same time, our macro is good. Our inflation numbers, let's say for next year, is likely to be around 5.25. We have real rates of close to 150, 175 basis point. So there is no reason for RBI to hike rates. But in the RBI policy, when RBI announced its intention of doing OMOs, we saw a further 10 to 15 basis point spike in our yields. We believe RBI is more concerned with the financial stability risk, and that has driven the decision to announce OMOs.
So considering all of this, considering the OMOs, considering the inflation, data as well, where do you expect the Indian 10-year government security yields to trade over the next couple of months?
So one more decision which is pending in the month of November is the likelihood of Indian bond getting included in Bloomberg Global Aggregate Bond Index. So that decision is due probably by end of this month, end of November. We should get clarity on that. We assign a higher probability of our bonds getting included. And let's say if that happens, we'll get additional $25 billion flows next year. So in addition to JP Morgan $25 billion flows, if we get additional $25 billion from Bloomberg, that will be close to $50 billion flows into our Indian fixed income market. Now let's look at this number in perspective. Let's say our current account deficit is close to $50 billion. So our current account deficit can get completely funded through these flows. Plus, let's say the $50 billion flow is close to 4 lakh crore and the government of India net supply is close to 12 lakh crore of bonds. So next year, 33% of the central government supply will be absorbed by these FIIs. So this is a positive news. But yes, so these will keep, so let's say global bond yields continue to rise high. Probably these flows will ensure that our rise is not as substantial as global bond yields. But in the near term, any upside will be capped because RBI has announced its intent to do OMOs, though they have not done any OMO till date.
So why is liquidity so tight, and how do you see liquidity panning out in the month of November?
The total liquidity in the system is close to 3 lakh crore. But since last 30-40 days, central government is keeping very high balances with Reserve Bank of India. As per our last estimates, the central government balances could be close to 3.5 lakh crore. So system on a whole is surplus, but due to higher government balances, the banking system liquidity is tight. So probably as and when central government starts spending that money, the liquidity in the banking system should ease. Plus we have close to 1,30,000 crore government of India bonds maturing in November. So central government, when they repay those bonds, liquidity in the system will increase. We expect the total core liquidity in the banking system to reduce to 1 lakh crore by March 2024. Yes, liquidity is tight. Liquidity is expected to ease in November, but central banker is going to ensure that it remain in a deficit mode till March 24.
Let's talk short-term rates then, up to 3 years. How do you see those rates pan out, say from now until March 2024?
We believe that credit offtake will continue to be there. This will be coupled with increase in supply in short-term assets, let's say up to 3 years. And liquidity is going to remain tight. So yes, yields have jumped up and they can inch up by additional 10 to 15 basis points from here till March 2024.
We have seen floating rate securities really pick up, in the last 1 year. What's your take on those and what's your outlook?
Broadly, let's say currently the carry on the floating rate bond is very attractive. Plus, over the course of last 3 to 6 months, the expectations of Fed pivoting has kept on getting delayed. And similarly, the expectation of any RBI easing has also got delayed. So these two factors, coupled with the fact that there has been relatively less supply of floating rate bonds, this has led to floating rate bond performing well over the course of last 6 months. And today, if you convert a floating rate bond into a fixed rate bond, the yield is relatively attractive as compared to a fixed rate bond.
Fixed rate, yeah.
And the last point that there have been changes in the bank investment guidelines where their ability to shift assets from HTM to AFS gets impacted starting 1st April 2024. So we believe that floating rate bond may be a choice of, maybe their preferable choice starting 1st April. So all these factors make us believe that floating rate bonds may continue to do well over the course of next 6 months to 1 year. And we see merit in having allocation to these bonds in our portfolio.
All right. So my last question to you, you've given us some very interesting data points. What is the advice you'd like to give retail investors on how they should invest in debt mutual funds?
So for a retail investor who is looking to park funds with an intent to do a SIP into an equity or a balance fund, probably they can look to park the funds in a funds category like low duration or arbitrage funds. They can choose those categories. So investors with, let's say, 12-month plus investment horizon can choose a 2 to 2.5 year duration fund. So the funds which we are recommending at the current juncture, the categories of funds where we believe investors with 12 to 18-month investment horizon can look at, they are, let's say, banking PSU fund, medium-term category of funds. They can also look at dynamic funds. At the same time, given the fact that currently 10-year GSEC annualized yield is in the range of 750 to 55, an investor who is looking to do a passive allocation for a period of 10 years, 5 to 10 years, we believe that these 10-year index fund also has merit and investors can look at these funds.
All right. Well, it's been wonderful chatting with you, Deepak. Thank you so much for joining us. That was, of course, the November month outlook for the fixed income market and what transpired in the months gone by. Stay tuned to Kotak Mutual Fund's social media channels.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.